We will convene. Mr. Yingling has a prior commitment of some considerable importance. We appreciate his staying around, and we will begin with Edward Yingling of the American Bankers Association.
Thank you, Mr. Chairman. I appreciate the opportunity to testify on H.R. 703, which will promote bank lending through changes to deposit insurance coverage, make improvements in the Hope for Homeowners Program, and provide prompt availability of capital through the Capital Purchase Program for community banks. ABA supports this bill. Let me address each of the major elements. ABA supports making permanent the $250,000 deposit insurance limit that was set on a temporary basis in the Emergency Stabilization Act. This increase from $100,000 helped heighten consumer and small business confidence and also resulted in additional funds to support bank. However, this increase expires at the end of 2009. It is important that this issue be addressed by Congress as quickly as possible. As a practical matter, with each passing month, it becomes more difficult for banks to effectively offer certificates of deposit over $100,000 because the expiration date on the insurance increase is moving closer. For example, by June, banks will only be able to offer 6-month CDs in the $100,000 to $250,000 range that are fully insured. Moreover, the expiration date and differing levels of insurance on CDs will be confusing to customers. It is important to note that the $100,000 limit, if the $100,000 limit had been adjusted for inflation when it was created in 1980, the level today would be $261,000. We also believe that enlarging FDIC's borrowing authority with the Treasury is a reasonable change, giving the FDIC more flexibility to manage cash flows related to bank failures. Cash flow issues occur as the FDIC acquires assets and failures that need to be sold off in an orderly fashion. We would emphasize that this is a line of credit and that any draws on it by the FDIC constitute a borrowing that must be repaid by the banking industry. We reiterate our continued support for the Hope for Homeowners Program. We believe the changes to the program recently announced by the Department of Housing and Urban Development have the potential to attract many more borrowers and lenders. We are pleased to see that further changes are included in the bill. We also support the provisions relating to securitization. It is widely agreed that the legal liability issues relating to securitization are inhibiting foreclosures. We also support the provisions in the bill that direct the Treasury to take all necessary actions to provide capital under the Capital Purchase Program to community banks, and to do so on terms comparable to those offered to other CPP recipients. We strongly believe that the current commitment should be fulfilled in order to prevent disparities from occurring and to competitive disparities from occurring, and to ensure that every community has the same opportunity for its banks to participate. For example, in many New England communities, mutual institutions predominate. Currently, those communities do not have the same opportunity for their banks to participate in the CPP. Finally, I feel compelled to mention once again another issue relating to the subject of this bill, which is lending and liquidity. While this committee works tirelessly to aid the economy, mark-to-market accounting continues to undermine any progress. As the Congress works to enhance bank capital, mark-to-market eats it up like a Pac-Man. But it's not just banks. In the past 2 weeks, we have seen accounting rules undermine the ability of the Federal Home Loan Bank system to provide liquidity. And we have seen a financial emergency in the credit union industry because of the impact of mark-to-market on corporate credit unions. An emergency which appears to be offsetting roughly the entire earnings of the industry in 2008, the credit union industry in 2008, through deposit insurance premiums. ABA appreciates statements by members of this committee on mark-to-market and urges you to make accounting policy part of your reform agenda. And Mr. Chairman, I'd just like to say that I agree completely with your comments about the conflicting signals that we have been receiving from different governing bodies, and I appreciate the fact that you're going to hold hearings on that.
Yeah, let me say, because I know you have to leave. And this is not anybody's fault. These are legitimate conflicts to be managed, and it has to do with capital requirements, stricter lending requirements, and mark-to-market. And I don't think the answer is 100% one way or the other on each of them. And I will be satisfied to some extent if I know that everybody's got both in mind. What worries me, as I said, is that you may have two different groups. But we will have that hearing fairly soon. Next, we will go to Mr. Michael Menzies. And Mr. Yingling, if you have to leave, that's understandable.
Thank you, Mr. Chairman.
Mr. Michael Menzies is President and CEO of the Eastern Bank and Trust Company from the ICBA.
Mr. Chairman, thank you. I'm Chairman and CEO, as you said, of Eastern Bank and Trust in Easton, Maryland, 62 miles due east of this hearing, and it's my honor to be with you.
I was hoping you weren't from Eastern Massachusetts. I would have been embarrassed.
No, sir.
I didn't know that.
But that's a beautiful
It
community,
said Eastern. I got a little worried.
Eastern Bank and Trust is a $170 million community bank, and we are focused on our community. I'm honored to be chairman of the Independent Community Bankers of America as we focus our representation exclusively on community banks. We applaud the efforts of this committee to promote bank liquidity, promote lending through deposit insurance, provide hope for homeowners, and enhance the community banking model. These efforts strengthen banks to expand ongoing lending activities and further support economic recovery. Community banks are the backbone of small business lending. Key provisions of your bill contribute directly to this mission, and as a result, create jobs. Your improvement to Hope for Homeowners expands the alternatives for community banks working with consumers who wish to avoid foreclosure. We understand that the committee will mark up some of the provisions of H.R. 703 in separate bills tomorrow, and ICBA urges swift passage of those provisions. I want to concentrate my oral statement on community bank liquidity issues and deposit insurance. Our written testimony addresses in detail all the issues covered in this hearing. Deposits are the primary source of community bank liquidity. Today, community banks face stiff competition for deposits. The increase in deposit insurance coverage to $250,000 has helped community banks be part of the solution to the credit crisis caused by the activity of a few large financial institutions. We're pleased that the Chairman's bill would make this increase permanent. ICBA applauds the Chairman for including a provision to give the banking industry more time to recapitalize the FDIC Deposit Insurance Fund, an idea that ICBA has strongly advocated. Community banks are prepared to do their part to maintain a strong, well-capitalized deposit insurance system. However, a longer period for recapitalizing would allow the FDIC to reduce proposed assessment rates. Lower rates would keep additional funds in local communities for lending to small business and consumers at this critical time. Last fall, the FDIC established a voluntary additional guarantee of all amounts above the $250,000 level in transaction accounts under the FDIC Temporary Liquidity Guarantee Program. More than 7,000 banks, including thousands of community banks, have chosen to participate in the Transaction Account Guarantee Program. The program is an important measure to enhance confidence of commercial customers in community banks and has been an important tool for enhancing community bank liquidity. This program allows Eastern Bank and Trust the opportunity to compete with the too-big-to-fail banks while paying a 10 basis point fee to keep the FDIC fund whole. The program also frees up capital and resources otherwise used by community banks to purchase treasuries and other securities that are used for repurchase agreements that secure commercial and public deposits. Community banks can better use the freed-up resource to promote lending in their communities. Taxpayers have no liability for the program, and the program does not reduce the FDIC reserve ratio. Participants are assessed a 10 basis point fee for the guarantee, and any deficit in the program could be made up by a special industry assessment. Unfortunately, the program expires at the end of this year. ICBA urges the committee to include a 2-year extension of the current transaction account guarantee program with other deposit insurance provisions that the committee will consider tomorrow. Eliminating the program at the end of this year would have a negative impact on community bank liquidity, again at a critical time. This important program should be extended by Congress to give the nation's deposit system more time to stabilize. Thank you so much for an opportunity to represent the community banks of America. Happy to take any questions that you may have.
Thank you. Mr. Taylor is now recognized for 5 minutes.
Thank you, Representative Maloney and Chairman Frank and Ranking Member Baucus, for the opportunity to testify before this distinguished committee. I'm honored to testify on behalf of NCRC regarding promoting bank liquidity and lending through depositors insurance, Hope for Homeowners, what we call H4H, and other enhancements. I want to inform Chairman Frank and other members of the committee that NCRC does strongly support H.R. 703. The new and amended provisions in H.R. 703 are important measures towards stemming the foreclosure crisis, restoring bank liquidity, and rebuilding consumer confidence in the financial system and the U.S. economy. H.R. 703's proposed increase in FDIC insurance coverage from $100,000 to $250,000 will help stabilize banks by increasing deposits. This and the increase in the FDIC borrowing authority from $30 billion to $100 billion will provide liquidity for the banking system and reassure investors that expanded FDIC insurance provisions will protect consumer investments and help prop up the banks. I want to applaud the Chairman for H.R. 703's amendments to Hope for Homeowners, which will improve upon an initiative that is really not reaching its intended goals. The proposed amendments in H.R. 703 will increase consumer demand for H4H. Eliminating the upfront premium and reducing the annual premium makes H4H a much more attractive program. Moreover, the amendments would allow FHA to eliminate H4H's annual premium payments once the borrower's equity reached levels consistent with standard FHA underwriting practices and products. Reduced equity sharing with the federal government is another welcome enhancement to H4H, and the new H4H would allow the federal government to recoup its investment at the same time while preserving significant wealth-building opportunities for borrowers. Another major advancement offered by H.R. 703 is the safe harbor provisions for services, which will increase the likelihood of meaningful loan modifications. This provision protects the services of investor lawsuits if the investor reasonably and in good faith believes that its loan modifications will exceed, on a net present value basis, the anticipated recovery of the loan principal that can be achieved through foreclosure. H.R. 703 is a major step in the right direction towards addressing the foreclosure crisis. However, in addition to that step, NCRC urges the committee to consider a broad-scale loan purchasing program. H.R. 703 still requires voluntary participation from the industry while offering safeguards and incentives. But there will still be the need for the government to proactively purchase whole loans, whether it is using the Help Now proposal that the National Community Reinvestment Coalition proposed now a year ago in January of 2008, or whether it's modifying the REMIC, the Real Estate Mortgage Investing Conduit Tax Code, to allow for the taking of whole loans, or other approaches like using the Commerce Clause and the Spending Clause of the Constitution, which allows the government to regulate interstate financial markets. Some proactive step like this is necessary to wrestle a lot of these loans away from the market. In closing, H.R. 703 is an important and necessary measure to stem foreclosures and stabilize the financial markets. NCRC is pleased to endorse it, and I will take questions at the appropriate time. Thank you.
Thank you. And Mr. Corson is recognized for 5 minutes.
Thank you. Thank you, Congresswoman Maloney, Chairman Frank, Ranking Member Baucus, members of the committee. Thank you for the opportunity to testify this afternoon on H.R. 703, a new bill intended to promote bank liquidity and lending. Of particular interest to MBA and its members are the changes for the Hope for Homeowners program, the focus on addressing servicer liability, and the improvements to the Troubled Asset Relief Program, or TARP. Let me begin with the Hope for Homeowners program, which was intended to be a tool to help delinquent homeowners avoid foreclosure, but has had trouble getting off the ground. H.R. 703 would remove the obstacles that have prevented its optimal use. For instance, the bill drops the requirement that borrowers have a housing debt-to-income ratio greater than 31% for participation. It also increases the maximum loan-to-value permissible under the program from 90% of the appraised value to 93%. These changes will allow more borrowers to qualify and also make the program more attractive to lien holders who will be able to take smaller write-downs. MBA also supports the language in the bill that addresses Hope for Homeowners' exceedingly high annual premiums by granting FHA flexibility in setting annual premiums that are in line with other FHA products. This reduction will instantly make Hope for Homeowners program more affordable for troubled borrowers. MBA appreciates the committee's efforts to provide servicers with greater legal protections for performing loss mitigation services. Although most pooling and servicing agreements allow for modifications and workouts, not all do. Some PSAs that allow modifications and workouts may contain conflicts, while others may be silent on modifications, thus increasing the risk of liability for the servicer. These problems have limited servicers' ability to help borrowers. MBA, however, is concerned that investors may challenge the validity of this safe harbor. If these challenges would prove successful, servicers will be exposed to significant legal liability and losses for breaching their contracts, despite their actions being within the spirit of this law. MBA would recommend that Congress include a provision that would indemnify servicers from liability if the safe harbor provision is deemed unlawful. Moving to the changes to TARP, MBA endorses this committee's efforts to provide additional clarity and direction to the Department of Treasury in how these funds are allocated. Above all else, it is important to return TARP to its original purpose, which was to purchase non-performing assets off of bank balance sheets. And while the government's focus to date has been on righting the residential mortgage market, we at MBA also recognize that the broader credit crisis has negatively impacted the commercial multifamily real estate sectors. Mr. Chairman, because this hearing is about bank liquidity, I want to take a minute to bring to your attention an issue that has and is hamstringing many independent mortgage bankers, and that is the shortage of warehouse lines of credit from commercial banks. These lines of credit are used to finance loans held for sale from origination to delivery into the secondary market. Warehouse lending capacity has declined dramatically from over $200 billion in 2007 to approximately $20 to $25 billion in 2008. For the originator that depends solely on warehouse lines of credit, this reduction could reduce liquidity, extinguish their lending business, and adversely impact the consumers in their market, stifling the real estate recovery before it has a chance to really get off the ground. The Congress and administration should take steps to maintain existing lines of warehouse credit and create new lines of warehouse lending by providing a short-term federal guarantee of warehouse lines that are collateralized by FHA, VA, GSE, and rural housing eligible mortgages, or one of several other alternatives that are also available. My written testimony discusses this issue at great length, as well as these other steps Congress and the Obama administration can take to restore faith in the mortgage industry and avoid future foreclosures. First and foremost, Mr. Chairman, we need stronger regulation of mortgage bankers and mortgage brokers. By working together, we can build a better regulatory system, one that works for consumers and the industry alike. MBA and its members want to be your partners as we move forward in these efforts. We also need to continue to strengthen FHA by investing in new technology, allowing them to hire staff on a par with other financial regulators, and we need to increase the loan limits for FHA and the GSEs. And we need to remember Ginnie Mae, which now securitizes 40% of the mortgage market and does that with less than 100 employees. Mr. Chairman, thank you for this opportunity to share our views and ideas with the committee.
Thank you, Mr. Carson. Just will note, the loan limit issue has been addressed in the House version of the recovery bill, so we'll be looking to keep it in there. Next, Mr. Michael Calhoun is President and Chief Operating Officer, Center for Responsible Lending.
Mr. Chairman and members of the committee, thank you for your...
Which, I do want to make clear, didn't used to be an oxymoron. And we hope to get to a point in America where it, once again, isn't. Please go ahead.
And I'm happy to report that we had a small operating gain last year on our lending to subprime borrowers. Mr. Chairman and members of the committee, thank you for your continuing efforts to ameliorate this deepening financial crisis. We are running out of time. 2 weeks ago, Goldman Sachs issued a report that projected that foreclosures could reach 13 million families, almost 1 out of 4 mortgages. This week, Mark Zandi, the leading economist of Moody's.com, observed that if we do not gain control of the foreclosure crisis in the upcoming weeks, it may be too late to prevent our economy from falling into a depression. In this context, I'll comment on the bills before the committee. It's appropriate that these bills address servicers, banks, and homeowners, as the fate of all three of these are tied together in addressing the housing crisis. All are currently suffering unnecessarily severe losses due to structural obstacles accidentally embedded in the structure of mortgage securities. Studies repeatedly find that loans not caught in the labyrinth of securities are modified more frequently, more forcefully, and more successfully to the benefit of all the participants. In reviewing these bills, it's important to note dramatically how the landscape of the financial crisis has changed over the past year. Originally, our primary concern was resetting subprime mortgages where interest rates and payments would increase. One of the few bright spots in this economy has been the decline in market interest rates, and that problem has been less than expected. That interest rate, though, improvement has been more than offset by the dramatic decline in housing prices. Today, more than 1 out of 5 homeowners with mortgages are underwater and owe more than their house is worth, and that number is rapidly increasing. That is what is driving the avalanche of foreclosures that continue to bury our economy. On top of this, banks are reluctant, for regulatory accounting reasons, to mark down the value of mortgage assets and loans. Ironically, by the banks overstating how well they are doing, we as a country are in fact doing far worse than we should be and could be. The failure to recognize these losses and modify mortgages is making this crisis much longer and deeper than it should be. Along with that, we have the obstacles of the pooling and servicing agreements. The bills before the committee today all address aspects of this challenge. Looking first at the hope for homeowners, we applaud the changes to make this program more flexible, and we urge that there be even more administrative flexibility so this program can be adapted to meet the crisis. We also urge that lenders acknowledge the need to reduce loan levels to reflect current values, and that judicial loan modifications be available to borrowers as a last resort as well. The next bill, which provides a safe harbor for servicers, provides an important benefit to help remove artificial obstacles to rational loan modifications. We further urge, though, that continued advantageous tax status for mortgage securities be conditioned on meeting these safe harbor standards. The structures that loans are held in, REMICs, are tax-advantaged structures. They do not pay taxes. It's simply passed through. The Congress has the authority to make it a condition of that tax authority continuing that they meet these safe harbor standards, and in doing so also avoid any taking implications that other approaches may involve. Finally, the bill addressing the FDIC provides sensible tools to strengthen our banks. As we learned a generation ago, while it may be in the best interest of any individual depositor to withdraw money at the hint of bank weakness, collectively such actions destroy our financial system, and government intervention through deposit insurance was essential. Similarly, with today's foreclosure crisis, individual actors are pursuing needless foreclosures that may appear to be in their best interest but are devastating homeowners and the overall economy. Intervention is again essential. In closing, we urge the committee to adopt these bills immediately, as well as other needed reforms. Thank you.
Next, we have Mrs. Robin Stout.
Chairman Frank, Ranking Member Bacchus, and members of the committee, I appreciate the opportunity to testify before you today. I am currently residing in Orange County, North Carolina. This region is farm country on the edge of what used to be small-town America, but now abuts the Raleigh-Durham, Chapel Hill Triangle. I was raised near Pittsburgh, Pennsylvania, so I do have a bit of perspective of city life as well. As a private citizen, I'm honored to have this opportunity to speak to you. Mr. Chairman and members of the committee, during the last number of months, my family has struggled to make ends meet because of the financial crisis. While I have been unemployed because of the housing construction downturn, my husband and I continue to change our activities. We cut back on unnecessary spending to make sure we can pay our mortgage on time and pay our bills. As my family and I continue to work and adjust our life, we cannot understand why we have to struggle while others are given a free pass on their mortgages. Many of the bailouts that have been undertaken will penalize those who have been responsible. We are going to pay higher taxes, pay higher mortgage fees, and not benefit from any rate reduction. This is the wrong approach and punishes responsible behavior. Let me be clear. I'm not here asking for assistance, but I feel that it is not right for many of Americans living within their means to have to pay for the cost of those who lived outside their means. I have bills to pay, and I believe I should be allowed to keep more of my money. I'm a second-generation American whose grandmother taught her the marvels of freedom and all the opportunities it brings. My mother and father taught me the value of hard work, honesty, integrity, with the reminder that pride does go before a fall. The constant lesson that was in America, you could map your success based on self-sufficiency, and if you ever fell down, the solution would not be found by depending on the government. You learn to get up, dust yourself off, and go for success again. To be in the august environment of this committee is overwhelming, but I would respectfully request that if the issue is to help the people of the United States, I have no problems with that, but at what cost to the taxpayers of America? Mr. Chairman, many Americans are angry that they are being asked to pay for the mistakes of a few. I believe that the solution is not found in bailing out a few homeowners, but in allowing individuals to keep more of their income and spend it how they see fit. This will help our economy. Thank you very much, gentlemen.
Next, Professor Edward Morrison of the Columbia Law School.
Good afternoon, Chairman Frank, Ranking Member Backus, and members of the committee. I'm Ed Morrison, professor at Columbia Law School. Last year saw 2.25 million foreclosures. Another 1.7 million are expected this year. Without prompt action, the foreclosure crisis will get much worse very soon. Over 4 million Americans are now at least 60 days late on their mortgages. Parts of H.R. 703 are a step in the right direction, but we can't consider this bill in a vacuum. The House is now considering a bankruptcy cram-down bill that permits homeowners to enter bankruptcy and ask judges to reduce their outstanding mortgage balances to the current market values of their homes. If this bill is enacted, H.R. 703 will be much more expensive and much less effective than it appears now. First, demand for the Hope for Homeowners Act and the cost to taxpayers could skyrocket. Homeowners will likely prefer the Act to bankruptcy cram-down because it offers a greater reduction in their mortgage balances. Lenders will also likely prefer the Act to bankruptcy cram-down because it offers immediate payment based on a manipulable appraisal value. By contrast, bankruptcy cram-down offers only a risky promise of future payment, and because Chapter 13 plans fail 2/3 of the time, cram-down may only delay foreclosure for years. As demand for the Act spikes and the government takes on a massive number of risky mortgages, cost to taxpayers could be enormous. Second, consider loans that are ineligible for Hope for Homeowners, perhaps due to HUD's qualifying standards. Among these, cram-down will devalue the safe harbor in H.R. 703. Bankruptcy will be more attractive than mortgage modification outside of bankruptcy, both to homeowners and to mortgage servicers. Homeowners will prefer cram-down because it yields a permanent write-down in the mortgage balance. Servicers will prefer it too because their costs are compensated in judicial proceedings, not in mortgage modifications. The cram-down bill undercuts H.R. 703, and it is bad policy for 3 reasons. First, it is unnecessary for the vast majority of mortgages. The government can freely modify 35 million of the 55 million outstanding mortgages it controls through Fannie, Freddie, and the FHA. Another 12 million mortgages are in the hands of private lenders, such as community banks, which are taking appreciable efforts to modify loans. These entities have strong incentives to do the right thing. They don't need interference from bankruptcy judges. Second, cram-down would yield a flood of bankruptcy cases, overwhelm the courts, and delay the crisis potentially for years. Every bankruptcy judge handles about 2,600 cases each per year currently. The courts would have difficulty handling a dramatically increased caseload with the care necessary to successfully modify loans. And even under the current caseload, 2/3 of Chapter 13 plans ultimately fail. Third, cram-down is expensive. Proponents argue that cram-downs will not cost taxpayers any money. That claim is simply not true. Taxpayers are on the hook for $5.6 trillion in mortgage guarantees from Fannie, Freddie, and the FHA. Other guarantees or loans have been extended to private lenders. Cram-down exposes taxpayers to the risk of losing billions of dollars as financial institutions suffer losses and need further capital injections from the government. Cram-down is the wrong approach, and so is actually Hope for Homeowners, because its guarantees impose high costs on taxpayers and because it applies a one-size-fits-all approach to mortgage modification. Columbia professors Christopher Mayer, Tomas Piskorski, and I offer a more effective, lower-cost approach. Unlike cram-down, our proposal doesn't interfere with mortgages that are already under the control of Fannie, Freddie, and the FHA. And unlike Hope for Homeowners, our proposal requires no government guarantees. We zero in on privately securitized mortgages. They lie at the core of the housing crisis. Although they represent only 15% of outstanding loans, they account for half of foreclosure starts. Servicers of these mortgages should be paid an incentive fee equaling 10% of mortgage payments, not to exceed $60 per month. This fee would align incentives between servicers and investors and make modification, not foreclosure, the preferred solution. If a mortgage is ongoing, the servicer receives a monthly fee. If it goes to foreclosure, the servicer receives nothing. In addition, the government should insulate servicers from legal liability when they have a reasonable, good faith belief that modification makes economic sense. This is precisely what the safe harbor in H.R. 703 does, but the bill should do more. It should require investors to compensate the legal costs of servicers who are sued but successfully invoke the safe harbor. Our proposal would avoid up to 1 million foreclosures, but the government can do more. Even among mortgages controlled by the GSEs, modification can be inhibited by the presence of second liens. The government should therefore offer second lien holders up to $1,500 to drop their claims when a primary mortgage is being modified. This plan could facilitate 1.4 million new modifications. Together, our proposals would address the current crisis at a cost of $12.8 billion payable by TARP funds. This approach is less costly and more effective than both cram-downs and Hope for Homeowners. I thank you for the opportunity to speak here.
Let me begin briefly, Ms. Marston. I appreciate particularly your legal analysis, because we do have the problem of, are we interfering with existing contracts? And the legal analysis, I understand you have some modifications you would make in the Castle proposal, but the legal analysis is the same, and I welcome it. I think that it's very helpful and useful to have. The only other thing I would say to Mr. Calhoun is that I am pretty confident now, and I just spoke to Senator Dodd and I've spoken to Secretary Geithner. I think a very significant mortgage foreclosure reduction program with tens of billions of dollars being made available, and all of the federally held mortgages involved, Fannie Mae and Freddie Mac and FDIC and the Fed. I believe, yeah, time is long overdue, and that will be happening very soon, I believe. Obviously, it won't solve everything. With that, I'm going to yield now to Mr. Cleaver, who set a very good example that was only intermittently followed by waiving his first round of questioning. So he gets to go now.
Thank you, Mr. Chairman. Mr. Stewart, I'm assuming you don't support the Hope for Homeowners bill as it is currently. I'm sorry, Mr.
My name tag.
Yeah, your name.
Mr.
Morrison.
I do not support the Hope for Homeowners Act, largely because, though it can be effective, it is much more costly than alternatives.
Okay.
So relative to alternatives, it costs taxpayers more money.
All right, yeah. And you don't support the cram down either.
Again, for the same reason.
Most of your opening comments spoke to the cram down.
Yeah, well,
probably 2/3, which is not in this
yes, but as
judiciary.
Right. As it began, I think that in considering H.R. 703 and its benefits and costs, you have to consider it in context. And the cram-down legislation seems to have a lot of momentum. And if the cram-down bill becomes law, it changes the way we need to think about it.
Well, it has to be introduced first. But
what,
the point is, I mean, you spoke about something that is not. And you spoke 2/3 of your talk to something that is not. And I was wondering whether or not you had anything to say about what is.
Right. As I said, I think as I began, the H.R. 703 is a first step towards a low-cost, comprehensive solution to the foreclosure crisis. And this first step would be undermined by cram-down legislation. The first step
Sir, excuse
is
me.
the safe harbor.
I'm sorry.
The first step is...
I'm sorry, you're a nice person, and I'm sorry to interrupt you, but you keep going.
No, but I'm getting to the safe harbor. Section 6 of H.R. 703 is the first step towards a comprehensive solution. We need the safe harbor because modifications, our foreclosure crisis is in large part driven by privately securitized mortgages. Servicers would like to modify these loans but can't. They face legal obstacles, which the safe harbor would clear away. They also face economic obstacles because it is just not profitable to pursue modifications. Modifications can cost $750 to $1,000 per loan. These costs are uncompensated, whereas if a servicer takes a loan in foreclosure, all of its out-of-pocket costs are compensated. So my proposal, together with my Columbia colleagues, is one that would take Section 6 of H.R. 703 and use it as a foundation. What needs to be layered on top of it is, at the very least, a set of economic incentives that encourages servicers to modify, even when they have the legal right to do so, as Section 6 permits.
Now, non-judicial encouragement hasn't worked so far in this program, unless you have some evidence otherwise. I mean, that's one of the things we've talked about, and so, you know, for me, living in a community with almost 4,000 foreclosures and a whole chunk of others en route, I'm concerned about what options we have available to make sure that these loan modifications occur, and what has happened. I think you would agree, wouldn't you?
Yeah,
that it hasn't worked.
We have done a canvassing of the industry and discovered that what is stopping we basically have a mass of lenders who hold bonds, who can't coordinate, and homeowners who can't get the ear of servicers because the servicers are so overwhelmed and there's not much profit in the business of servicing. So we want to convert that into a profitable enterprise. I'm not aware of any evidence that would suggest that our proposal is flawed. What we're doing is that we're unlocking the servicing box and freeing servicers to modify when it makes economic sense. Keep in mind, a lot of servicers are failing, going bankrupt.
Yes.
We're offering a strong carrot that would allow these servicers to thrive, make it a profitable business for a change.
Yeah, I'm trying to get the homeowners to survive.
But remember that the only way servicers get paid is by avoiding foreclosure.
Gentleman, sorry.
Mr. Yingling left. Mr. Yingling, do you support? I know the answer, but do you support some kind of judicial loan modification?
We support the provisions in this bill to help for homeowners, and we also support the aggressive use of TARP funds to help with foreclosure. Housing is at the root of this problem, and we must address the foreclosure crisis.
I was juxtaposing your position with Mr. Morrison. I'm sorry. I mean, I guess maybe it's there's some kind of symbolism with the two of you on the ends, but I'm wondering whether or not.
If gentlemen can finish the question, we give them extra time.
Well, if we're able, I mean, we've got to try something. I'm not going to be a part of the do-nothing crowd to let things go. And it is your opinion that this legislation is the best thing we are considering right now, that is on the table that you've heard discussed.
Well, this, but also the aggressive use of the TARP funds that the chairman referred to.
The gentleman from Texas, Mr. Martian.
Thank you, Mr. Chairman. I think one of the parts of this discussion that just took place, and if I could ask for a clarification, the chairman has the chairman stated that the cram-down legislation will be merged with this before the floor, because that's not the case, then maybe a lot of this discussion.
It's up to the Rules Committee and the leadership, and it's, I think, still unclear. There was some talk about trying to put it into the omnibus. People talk about that. The one thing we can control is do this by regular order. So, you know, we're going to have our hearing. We're going to have a markup tomorrow, and at that point, obviously, leaderships decide whether it goes to the floor freestanding, whether it's packaged, whatever. I know there are people who have talked about packaging it with bankruptcy either as a freestanding package or as part of some other package.
Okay, thank you. My questions would be to the two bankers, and I would like for you to expand just a little bit about the mark-to-market aspect of the pressure that's on the banks with your mark-to-market, the mark-to-market influences that makes you be so reactive, and how it would restrain you from pursuing modifications.
Congressman, speaking as a community banker, we have not had a challenge with mark-to-market on our balance sheet as of this point in time. But there are community banks throughout the country that are struggling with mark-to-market. If you make a legitimate, performing 30-year mortgage loan and it's paying as agreed and you've got to follow the current mark-to-market standards, it hurts your capital, that hurts your ability to leverage your bank, that hurts your ability to lend into your community. So mark-to-market has got to be revisited holistically.
And when you say mark-to-market, you're saying that a standalone 30-year mortgage, the regulators would come in and say, what could you sell that mortgage for today, and thus market to market?
We have not had that experience, no. And
that is the experience.
I don't believe that regulators are going and looking at an Eastern Bank and Trust 3-year maturity, 30-year amortization loan and saying market to market. It's the portfolios that are making you mark to market, in particular if you're into the private portfolios. We're not. We're strictly into Fannie Freddie short-term conforming paper, and we've not yet had a mark-to-market issue.
So the community bankers are not experiencing the pressure of mark-to-market like the big bankers?
I would recharacterize that as the community bankers are not experiencing as much pressure as the largest banks of the nation with mark-to-market. We are experiencing pressure on mark-to-market.
I would just say that I've talked to a number of community bankers where this is a huge problem. And I'll give you two quick examples about how it can affect lending outside the traditional bank industry. The federal home loan banks, just in the last few weeks, because the accountants came in and said, we're going to take your mortgage, your private mortgage security portfolio, and we're going to make you market to the market, have experienced a contraction of their capital. And yet when Moody's looked at that number, and I'm doing this from memory, so I'll correct it if it's wrong for the record, they said it's a $13 billion write-down on capital. But when they looked at the individual securities, they said we project the actual loss at $1 billion. And so here you've had a $12 billion hit to capital of the home loan banks, and that's cascading back down into community banks and hurting their liquidity. The credit unions, just in the last couple of weeks, took a massive hit, relatively speaking, to the corporate credit unions, where they had to have a huge, in effect, guarantee from the credit union insurance fund, and most of that was mark-to-market. And I understand the committee may be looking at the way that insurance premiums for credit unions are currently paid, but right now, under our analysis, they would have to pay basically all the earnings from 2008 to their insurance fund because of this guarantee caused by mark-to-market. So that's going to have a cascading effect down to the availability of mortgages, for example, from credit unions.
Mr. Chairman, I look forward to the hearing that you've announced that we'll have, where you are going to put the regulators and the bankers and make sure that there are not cross purposes going on here. Because I would contend that as hard as we push to solve these problems out in the banks, during the examinations and with every aspect of banking now, there is this pressure that is preventing them from making loans, preventing them from doing business as usual. That is the biggest example is here. If you buy security and intend to hold it to maturity, then that's one.
Well, yes, we will be pursuing that. And I just want to say to Mr. Yingling, and I know we had a commitment, but I am especially appreciative that he stayed long enough for that expression of solicitude for the credit unions. It was duly noted and appreciated. The gentleman from New York.
Thank you, Mr. Chairman. I'd like to ask Mr. Yingling and Mr. Menzies, the hope for Homeowners Program has clearly not refinanced as many mortgages as we would have liked at this point. And one of the criticisms of the program has been that lender participation is voluntary. With the bill you're supporting and the changes you're supporting today, what assurances can you give us, if any, that with these changes we will see a greater degree of lender participation?
Well, I think you will see a greater degree of participation. I think also one of the important things here is that with this program and with the program that will be developed under the TARP, which will, we presume, look somewhat like the FDIC program, and providing flexibility in those programs to adjust to whatever problems we find going forward, we're creating a flexible system that can adjust. I think one of the problems has been that we've had to write in hard wire requirements here and there with no ability to adjust to what has clearly been a very rapidly changing circumstance. And then again, the part about securitization is very important. A number of the members have commented on how the threat of litigation in the case of securitized loans has been maybe the biggest impediment that we faced, and this bill deals with that.
Mr. Menzies?
Congresswoman, I think that we absolutely will see more volume at FHA. There's no question that we need to deal with the technology side, which has been an encumbrance on this whole process. The FHA would benefit from an upgrade of its technology. But I believe we'll see more, and I think it does give us some hope.
And Mr. Taylor and Mr. Calhoun, would you like to comment on your belief whether or not this will increase participation by the lenders or any other incentives or proposals that might help us stem this loss of homes in our economy? I must say that throughout this process, from the very beginning, economists have said that the number one deal we should focus on is helping people stay in their homes. And if we don't do that, then the value of homes are going to fall. It's going to a downward spiral of our economy, and yet it seems to be not getting the proper attention that it deserves, given the fact that people say this is the number one issue in order to try to stabilize our housing markets and our economy. So I'd like Mr. Taylor and Mr. Calhoun to comment on it if you could.
And I think there's, thank you, Representative Maloney, and I think there's great misperception out there that there is, in fact, a lot of help being offered and a lot being done to help homeowners. And when you sit here and you listen to the Help for Homeowners has done 25 loans of 400,000, which even then, when that number came up, we were all critical that that's just a drop in the bucket. Well, they've done 25. It's almost a bad joke. But at least now with the terms and conditions that this committee and the chairman has offered, I think there's a real potential here. Putting the new terms and conditions, which I think treat the consumer better in this process, but also create the safe harbor for services, put that together with some of the top funds. I think there's a real opportunity to make a dent in this, but I still think we're going to be challenged down the road. And I hope I'm wrong about this, but I think unless there is a proactive step in which we step into the market and pull these loans away and direct those services, whether they're working with FHA or whether they're working with the market, because pulling these loans down at a discount using the various methodologies that we've been proposing for a year now will reduce those mortgages in and of themselves when they're purchased, so that the market itself, the mainstream banks, the community banks would be able to refinance these using the savings that occurred from purchasing these loans at a discount.
John, if I can add, I think originally, Hope for Homeowners, there was talk going way back of pairing it with the bankruptcy reform, that it would provide, if you will, a carrot and a stick, and we've had no stick here. And I know we had 300,000 foreclosure filings in December. The crisis is still going at full bore. I would commend to everyone the Credit Suisse report on bankruptcy that they performed a detailed analysis issued a week ago. They found it would reduce foreclosures by 20%, that it would encourage more voluntary modifications by providing some pressure for those, that it would provide a good return to lenders, and it would not hurt the cost or availability of future mortgages. And I would note for Mr. Morrison's proposal, there's some things we agree with there, but it doesn't address the fundamental problem that a large percentage of these troubled mortgages are underwater, and you can't refinance them easily.
Thank you.
New Jersey, Mr. Lance.
Thank you, Mr. Chairman. To Professor Morrison, as I understand it, you propose a litigation safe harbor based upon a servicer's reasonable good faith belief that it was acting in the best interest of investors. Do you have a concern, Professor, that there might be conflicting interpretations across the various federal circuits if we were to use that standard?
I have as much concern about that legal standard as I would be concerned about any legislation being interpreted differently by different courts. I think this standard is as clear as any legal standard could be, other than one that absolves servicers of any liability, which we definitely do not want to do that. We want to have some sort of incentivizing of servicers, not just the incentive fees that I've proposed, but also legal liability as a spur to act in their fiduciary capacities. Put differently, the safe harbor that we propose, and which is identical to the one in H.R. 703, uses a net present value test, which is very similar to the ones that, very similar to the test that's routinely applied in Chapter 11 reorganizations. A judge is asked to decide whether the recovery to creditors will be higher in a reorganization than in a Chapter 7 liquidation. So this is a formula that's applied routinely, and I don't expect it to be applied in a fundamentally different way across the nation. And moreover, the way it's structured, it's a deferential test. It's based on the belief of the servicer, not on some evidence that after the fact the modification wasn't successful.
Thank you. Regarding cram down, I'm of mixed emotion about it. Certainly there were many who were victimized, and I think Congress, on a bipartisan basis, wishes to address that issue. But you do raise the point that this might create moral hazard. I think many who favor it believe that losses will occur between the lenders and the borrowers. And yet, as I understand your testimony, and I have read your testimony, Professor Morrison, you believe that the taxpayers will end up bearing a substantial portion of the costs. I think you indicated in your testimony to the committee that there were, did I hear you correctly, $5.6 trillion involved in mortgages?
At least, in terms of our commitments to the GSEs, I don't think that even counts. I don't think my calculation counted the various commitments we have to the banks and other institutions that are exposed to the mortgage cram-downs.
And you also indicate that you think eventually that this will lead to higher borrowing costs for everyone, that is in your written testimony. Could you explain that in a little more detail, Professor?
Right. So the current legislation, or at least H.R. 200, has a time limit. It would apply only to mortgages originated.
But you indicate in your testimony, and I've read it, that you think Congress would be under enormous pressure in the future to modify that.
Right. I mean, this provision, the cram-down, has been long advocated, regardless of the economic environment. And it seems likely that, based on my analysis, that bankruptcy cram-down could just defer the crisis, and as the crisis lasts longer, there's going to be pressure to apply mortgage cram-down laws to mortgages originated after the effective date. And if bankruptcy cram-down becomes a permanent feature of the code, there is no doubt that it will affect credit markets. The Credit Suisse report that was just cited by Mr. Calhoun is riddled with errors, one of which is its reliance upon a study claiming no effect on credit markets from mortgage cram-down. That very study, and I can point you to the exact tables, finds just the opposite effect with respect to disadvantaged borrowers, meaning borrowers who have imperfect credit records. And the study was not of the subprime era, it was of the early 90s. So we're not talking about a subprime kind of borrower. We're talking about someone with marginal FICO scores. And for these people, that very study, which the Credit Suisse seems to misreport, that very study finds a reduction in loan-to-value ratios and an increase in interest rates for these disadvantaged borrowers.
Thank you very much, and I look forward to pursuing this further with you as we analyze this issue further. Thank you very much, Mr. Chairman.
Gentleman from North Carolina.
Thank you, Mr. Chairman. I want to get
three questions in, Mr. Yingling and Mr. Corson. I would like your reaction to whether the concept of a bad bank creates a moral hazard. I would like the two of your reactions to the Credit Suisse study that Mr. Calhoun has made reference to. And if there's time, I would like anybody's reaction to how this Senate proposal, the proposal that's floating around on the Senate side for a 4.5% interest rate on mortgages plays into this whole situation. Mr. Yingling.
Well, first on the good bank, bad bank, it's been touched on, and I think the real problem with it, not an insurmountable problem, but is valuation. And I don't know how you evaluate those assets in a way that, given some of it's mark-to-market, given the fact that if you value them at the current mark-to-market, it's way too low, and if you value them higher, I think some of you are going to say, well, are the taxpayers being disadvantaged? So I believe the administration is looking at a dual model where people could use that if they wanted, if they'd already marked them down and maybe haven't guaranteed.
So your opinion is it's a moral hazard if you don't get the valuation right?
I think it's almost impossible to get the valuation right, but it may be that if they combine it with people who want, if a bank wants to say I've marked it to market, that's what I'll offer it. And on the other hand, they could go for a guarantee where the valuation
Mr. Carson, respond to the Credit Suisse study.
Congressman, I'm not familiar with it. I have not read that study. So
have you, Mr. Yingling?
I've read a summary of it.
What's your reaction to it?
Well, I think it does have some problems. I think that in many ways this is a cost-benefit analysis, and I think there's a way to reach a compromise on this, because if you look at the benefits that people talk about, we can argue about how big they are, but the idea is that it will help some people stay out of foreclosure. And on the cost side, I do think that the study is wrong to the degree it may imply that there's not a cost. There will be a cost going forward in terms of higher interest rates and in terms of
even if you limit it to this short duration in time that the Senate proposal is supposedly limits it to?
That helps. One of the problems is they keep using date of enactment, so I have bankers saying to me, well, what should I be doing right now? But I do think most of the benefits would be on the side of looking at the kinds of mortgages that probably shouldn't have been made, and those are where the real problems are. And if you limit it to those, then you don't have as much of a cost, because going forward, presumably lenders aren't going to be making those kinds of loans. So I think there's a way to finesse this and get some kind of compromise in that sense.
I'm glad to know you all are moving toward a compromise. That's music to my ears. Mr. Calhoun addressed this 4.5% interest rate proposal and what impact it has in this whole equation.
I think they're related. We have seen tremendous interest rate relief already, and that's been helpful, but not enough to stem the foreclosure crisis. Again, I think there's agreement here. A huge part of the troubled mortgages are underwater mortgages held in private label securities. The problem there is the interest rate in terms of refinancing. You can't refinance underwater mortgages even at favorable rates. You need some other assistance. That's why eventually there has to be some sort of write-down or subsidy involved. And the cram-down, I think it's important. People talk of this cram-down like it's a drive-by cram-down. You go into your local Sonic and say, I want a cram-down, pay for it, drive away. It is a tough road to hoe. You have to be in a bankruptcy plan for 5 years, give up your right to any new credit, apply all of your disposable income to pay off your secured and unsecured debts, and under the compromise that came out of the Judiciary Committee, there's a so-called clawback provision. If your home appreciates over the 5 years of the plan, you have to share a large part of that appreciation with your lender. So people talk about this like it's an easy walk-in thing. There are a lot of safeguards there so that it reduces the potential for any moral hazard.
Thank you, Mr. Chairman. I yield back.
The gentleman from Texas.
Thank you, Mr. Chairman. Ms. Stewart, let me just say this quickly. I thank you for coming. Your story is personal in a sense, and we appreciate very much your sharing with us. Thank you very much. And I thank all of you for coming, of course. But Mr. Morrison, may I ask, have you written any white papers comparable to the one that I have, or some body of knowledge that deals with cram downs for business?
Cram downs for business?
Yes, sir. You agree that we have cram downs for businesses, don't you?
Well, we have in Chapter 11 plans.
Right. I would call that a cram down. You wouldn't call that a cram down?
Yeah, there's a version of the cram down, though creditors can opt.
Have you written any papers in opposition to that?
No, I have not.
Anything on cram downs? Have you written anything opposing cram downs for my second, third, fourth, or fifth home?
No, I have not.
You do agree that we have cram downs for second, third, fourth, fifth homes beyond the first?
Yes, and we expect that the credit markets are very different for those kinds of homes.
I understand. Well, let's just examine.
I can make a mention. In Chapter 11, for example, there are
before you do that, I think I'm going to have to take control of the time because I have so little. Permit me to ask this. With reference to the businesses having the opportunity to cram down, what is it about the residential homeowner that is so greatly different from that of the business having the opportunity to cram down? And I want to talk about now for a specific window. Let's just talk about the subprime mortgages only. Let's take, say, a 4-year window, none before, none to come after. What is it about that class of people that would make them unacceptable for a cram down when businesses can get it?
Well, I think the relevant comparison is what is, as one of your colleagues, I think it was Representative Sherman said, is that we want a solution that costs taxpayers the least amount of money. And I agree, cram down would reduce foreclosures. Hope for homeowners would reduce foreclosures. But we have to ask, how much do taxpayers get charged for these policies? And I think that the relevant question for policymakers is to ask, what alternatives are available? And my colleagues, Christopher Mayer, Tomek Piskorski, and I put forth a proposal that does as much work, more, we think, than cram down or Hope for Homeowners at a fraction of the cost. That, for us, is a strong reason not to go down the cram down route, which we fear could delay a crisis that is of a different order of magnitude. We may talk about cram down for businesses, but we're not talking about...
If I may reclaim my time, the essence of your contention is that this is much more cost-effective to avoid the cram down and to go solely with the Hope for Homeowners modification program. Is this correct?
No, my proposal is to that is not Hope for Homeowners. I think Hope for Homeowners is relatively costly compared to the proposal I outlined in the white paper I submitted with my
You're
testimony.
talking about 788, the Safe Harbor program.
Well, the Safe Harbor tied to economic incentives for servicers to help homeowners.
So is your position that that would be a more cost-effective way to approach this?
Yes.
Okay. Now let's examine that for just a moment. And I tend to like the program myself, but I do want to ask this. Do you agree that people who can win lawsuits, generally speaking, don't enjoy being sued or would prefer not to be sued?
People who, I'm sorry, what do you mean by...
Who can win lawsuits, who have the law on their side, who have the long arm of the Congress, having provided them a safe harbor. Do you agree that they, generally speaking, don't enjoy being sued?
That is correct.
Do you agree that there will be litigation with reference to persons who participate in this program, which is why someone mentioned indemnification earlier?
That is exactly why in my testimony I suggest that I agree with, I think with Mr. Corson with respect to that indemnification. I think that is a good idea. Also, we need to have a cost-shifting provision such that if lawsuits are brought, the losing party pays the fees. the losing party pays the fees of the winning party. Meaning,
Could I, if the gentleman would yield, when you talked to your $12 billion cost, though, you didn't have indemnification in there, did you? Would that add to the cost significantly?
well, these would not be costs of the government. These would be costs that...
Well, who would indemnify them? I thought indemnification was by the government.
We're mixing up two kinds of indemnification. One, which is not on my proposal, is Mr. Corson's, which would cost the government.
Okay, well, you said you would agree with Mr. Corson on indemnification.
Excuse
me, stop, please.
Never thought.
And I'll give some extra time here by unanimous consent, but...
That's the way I'm going, Mr. Chairman.
Yeah, I mean, you said you agree with Mr. Corson. I had understood Mr. Corson to be talking about taxpayer-funded indemnification. And if that were the case, it would be an added cost to your proposal.
Never thought of it, but I think it's a good idea.
But it does add to the cost.
Yeah, we'd have to. I can do the calculations.
Thank you, gentlemen.
Thank you, Mr. Chairman, and I will yield back in the interest of time.
More time, please.
I yield back. Thank you.
I thank the panel. Oh no, gentleman from Florida. I did not realize he'd come back. The gentleman from Florida.
Thank you, Mr.
I'm not used to
Chairman.
looking on the other side for.
We're all struggling here with ways to try to get the economy moving again, and we're all looking to the credit markets to make that happen, to stop the decline in credit, to accelerate the expansion of credit, to make the economy come alive again. We all do that with limited resources. We can help and only help to a certain extent. There are banks that have made terrible mistakes over the past few years that have led to hundreds of billions of dollars of losses. And there are banks that do their jobs well. There are banks that do the jobs of banks every day. Smart lending, smart borrowing, nothing goes wrong. So I'm going to ask you all individually for as much time as we have. I'd like to go from left to right. You tell me, should we be helping the good banks or should we be helping the bad banks? Let's start with Mr. Yingling.
Well, I think you, to some degree, have to do both. I think maybe those in the middle are the ones that aren't getting the help now, and that may be correct. I think if you look at the way the capital purchase program was designed, it was designed to help only healthy banks on the theory that you put capital in them, you built a strong capital base, and they could go out and lend to their customers and pick up the customers of others that may be where credit might not be available. I think there are going to be some institutions, if they are systemically important, that are going to have to be taken care of. And those in the middle, I think, under the current program, are left to go to the private markets and raise capital when they can.
Congressman, community banks stick to their knitting. We're well capitalized, we're well managed, we're well regulated, we lend into our communities, and community banks can make a difference in this recovery. I can't tell you whether we should save the systematic risk banks or not. That's a big, heavy decision that's up to all of you. But I do believe that the community banks, with greater access to deposit funds and with greater access to capital, can significantly improve the rate of recovery in communities throughout America. We have stuck to our knittings. We are not too big to fail. We are not too big to regulate. We are not too big to supervise. We are not too big to govern. And we are not too big to punish if we misbehave.
I have the trouble answering the question because I'm not sure what's in your head as to what's a good bank or a bad bank. But in some ways, I think we're so beyond that discussion because, as Mike said earlier, to paraphrase him, I think the services, the banks, the communities, this Congress, we're all in this together. If we don't find a way to stabilize our financial services sector and to deal with these problems, it isn't going to be a matter of who was the good guy, who was the bad guy, but it's going to be a matter of how far we go into this recession and whether we go into what Zandy is calling a potential depression. And I think what we need to do is create as much liquidity as possible and do something we haven't done yet, and that is help the homeowners, help the source of what was the original impetus for this recession, and stop the foreclosures and go right after the people who are still working, who are able to pay on their mortgages, and would gladly continue paying on their mortgages if they could get on the one that wasn't predatory.
Congressman, the mortgage markets and credit markets are just seized up, and we've got to have liquidity. So I'm not putting labels on anyone. We have to create liquidity. We have to, using the TARP funds, figure out a way that we can liquefy these balance sheets. We can get these bad loans either corralled or off the balance sheets to create liquidity, and having done that, then take control, as the chairman talks about, find a way, as we've talked about here, of dramatically and aggressively dealing with those loans once we get the arm around it. But we've got to have liquidity in the marketplace, regardless of whether it's a large national bank, community bank, small regional bank.
I think you help both, and you do that primarily through stabilizing the housing market. As a lender, and I think all the lenders here will say, it is almost impossible to lend in a market with declining values. You have to charge such huge premiums. And the Credit Suisse report, they estimate that every foreclosure imposes an externality of $300,000 in reduction in housing values on other properties. And if we allow these foreclosures to keep rolling on, there is no floor. You can't have liquidity. And I want to emphasize that while we think the cram down is an essential part of that strategy, it is a part. I think...
Well, that's not really the question, and we do have... I'll see if the other two witnesses want to add anything.
I would like to say something as a homeowner and a taxpayer who is caught in the squeeze. I understand that these problems are way bigger than I can even begin to speak to. What my concern is that many of the moves that have been done by the government has kept an artificially inflated market going. The values of homes are staying higher than they really are. That's why we have all this underwater mortgages everywhere. And it's, to give you a quick example.
We haven't got a lot of time.
Very quick. I just got a 20% increase on the value of my home during revaluation in our area. There are for sale signs everywhere, but we were all reevaluated 20% higher because they need to generate revenue. I just want us to be careful.
We really are kind of
rushed for time. I just want us to be careful what we choose to do. If government chooses to help anybody, not just the banks, please consider the taxpayers, because we are overburdened. Thank you.
Mr. Morrison?
We may need regulation to prevent banks from going bad, but right now we need to stabilize our financial sector. If we don't stabilize the financial system, both good and bad banks will see unemployment on Main Street. Academic studies have shown this. When WorldCom defaulted on bonds that held by banks, those banks suffered distress and reduced lending at local branches throughout the country. It's as simple as that.
Thank you, Mr. Chairman.
The final question, the gentleman from Minnesota.
Thank you, Mr. Chairman. And I just had a question for Mr. Menzies. Some of this may have already been covered before, but I know there's been a great deal of focus given to TARP, obviously, and a lot of the questioning that's gone on today as well as in the Congress. And it's really been a means of getting capital into the hands of the lenders, obviously. But I know that community banks, which are obviously organized across the full range of charter types, have had a variety of concerns and problems relating and gaining access to the program itself in general. And I'm just wondering if there are other ways that Congress can specifically help get capital in the hands of the small lenders to really feed the small business community.
Thank you for your question, Congressman. On a very personal note, as a Subchapter S bank, if Congress would authorize IRA accounts and 401ks to invest in Subchapter S companies, that would dramatically increase our access to capital. And there are over 2,500 Subchapter S banks of the 8,380 banks in this nation. And if Congress would continue to encourage the Treasury to direct CPP monies to the community banks of the nation, that would be great as well. You note that most of the community banks of the nation have not yet taken advantage of TARP. We think it's important that those banks who can take advantage of the CPP program do so and use that money to lend into their local communities. We have a local bank that took advantage of TARP, and from all of our perspectives, they're using it very responsibly, and they're leveraging it, they're lending it out 10 to 1. They're doing a great job for the community. As a Subchapter S bank, we've yet to go through the process of interpreting the term sheet, so we don't yet know if we're going to take advantage of CPP. But those would be my thoughts for community banks.
Have you got a term sheet yet?
Yes, sir, we do
You
have
do
a term
have,
sheet.
okay. I
We've
guess the
studied it,
mutuals
and we
that don't have-
submitted our application.
The mutuals don't have them, but you have them. Okay.
The mutuals don't have them. That's an
Yeah.
important point, Mr. Chairman.
All right,
We
I
think-
understand, but we're not going to repeat it.
I yield back, Mr. Chair. Thank
All
you.
right, I thank the panel, particularly sometimes when we're running late, people's attention is more focused, and the later things tend to be very useful. Thank you all for your contributions.